Being in a position to invest is great, but it also means having to deal with new and complicated kinds of taxes. In this video, we'll talk about the different kinds of investment income and the ways that you can manage the tax obligations that they create. Let's start with capital gains. Capital gains are the difference between the price you bought an asset for and the price that you sold it for. So if you purchase $10,000 worth of stock and then sell it for $15,000, that's $5,000 in capital gains. This tax is different depending on whether you've held the asset for less or more than 1 year. Long-term gains have their own tax bracket, while short-term gains are taxed using the standard tax bracket. In both cases, the tax rises with your overall income. For example, if your sole source of income is $35,000 in long-term capital gains, you won't owe any tax. But if you make those gains on top of a salary of $1 million, you'll need to pay 20% on that $35,000. With capital gains taxes, timing is extremely important. For most people, a gain being long-term decreases the tax burden by quite a bit, so before selling an asset, check on the purchase date. Also, keep in mind that capital gains taxes are assessed in the year that the sale is made. Depending on your expected income in any given year, and the amount of capital gains that you stand to realize, it might make more sense to time sales for 1 year or another. While keeping track of purchase dates of individual groups of assets over time can be confusing, brokerage accounts take care of a lot of the work. Assets are broken up into individual lots depending on their purchase date, which is especially useful when you've bought batches of the same stock at different times. Typically, you'll have the option of choosing from which lot you sell, which gives you much more control over what taxes you'll have to pay and when. Of course, capital gains aren't the only kind of investment income. If you own stock, you might also receive dividends, which are earned when a company periodically distributes profits to its shareholders. Ordinary dividends are taxed using the standard bracket, much like short-term capital gains. However, there are also qualified dividends, which are lumped together with long-term capital gains. In order for a dividend to be qualified, certain requirements need to be met. The dividend must be from a U.S. company or a qualifying foreign company, and it must be held for a certain amount of time. There are also certain kinds of investments for which dividends can't be qualified, like real estate investment trusts. For most long-term investors, this means that most, if not all dividends, are qualified, whereas things become more case-by-case for people who make more frequent trades. Finally, if you have investments that pay interest, like bonds, your income will usually be taxed using the standard bracket. However, certain kinds of bonds, like municipal bonds issued by the town or city where you reside, could generate tax-exempt interest. You still have to report it to the IRS, but you don't owe any money on it. Capital gains, dividends, and interest are the main kinds of investment income for most people. There are, of course, other kinds as well, but they aren't as common and are either straightforward or very, very complicated. Either way, we won't be talking about them more here. Now, it's worth noting that this information really doesn't matter much for investments in IRAs or 401ks. You still have these kinds of income, but none of it is taxed, or even reported. These special kinds of accounts are really important to be familiar with, but they're a topic for a separate video. With taxes, a little bit of knowledge goes a long way. Now that you understand the basics, you should be able to make small changes to your investment strategy that reduce your tax burden.